Hello, everybody. Thank you so much for coming out, taking the time. I know it's a little bit late here on the West Coast, and I think we have a couple folks with us from across the country. So great to see everybody. The whole purpose of this is just to get you educated on the long term care landscape as it is in the United States right now, because it's very odd in the insurance industry. Sometimes consumers tend to kind of take it in shorts with most products and stuff that are out there, right? Everybody's always trying to make an extra buck and deliver a little bit less. Ironically, the long-term care market is actually the opposite to where things used to be really, really good. Then they got pretty terrible, and now they're actually pretty decent. But we're just going to touch on basically some of the numbers and facts and figures behind long-term care, kind of help you frame it up in your mind on how you want to think about it, what it may end up costing you, that kind of thing. Then it's really important to kind of go over a couple legal technical definitions of long-term care and how that fits into today's current market. And then we'll just briefly touch on a couple different ways that I personally, in my financial planning practice, help address the need for long-term care coverage. But really, more importantly, what I address is eliminating a lot of the stress and the pain and the things like that we all know we're going to have to face when it comes to that point in our life. So I got about 27, 28, 30 minutes before I got to get out of here and go coach lacrosse in the freezing cold, because we decided to play lacrosse in the middle of November. Never played lacrosse before, but my son got into it and I love it. And so we'll try and make this brief, just real briefly, to kind of just give you an idea of why I do these educational webinars. It's because my firm has always been very mission driven. And, throughout my history of being in the Marines and being a police officer, I've always just tried to be a servant and really make a positive difference for people. And I was dealing actually with a couple up in Woodinville, which is a city north of us here. And they actually own an adult family home, and they do skilled nursing and having home care. And right about the same time I was helping them out with some financial planning, my grandfather got very sick. He was a lifelong smoker. That didn't help. So I kind of went through this phase in my life where I saw what end of life care looked like. At the same time, I was helping them out and I was doing their finances. And I can tell you that the adult family home industry is very, very lucrative. So this was a couple that you would not typically expect to come to me, heart on their sleeve, really looking for help with something like long-term care planning, because quite frankly, they had enough money for me to manage and make sure they were going to be well taken care of. And we were just talking, and she just started to get tears in her eyes, and she said, I can't handle the thought of, like us not being able to take care of ourselves. Even with as much money as we have, we need something in place just to have that peace of mind. So that really kind of changed how I viewed long-term care planning, that in conjunction with what I was going through in my own personal life. And so I just know the type of peace of mind that having these kind of things in place can bring. And that's really what I value in my practice with my clients. And let me get the PowerPoint all fired up here, and off we will go. Okay, so uh, that's me. Everybody, I think on this webinar, I probably met personally. So I'm a chartered financial consultant. That's just a kind of a step above a CFP. It took me about 3 years to obtain that. And Capital Partners Wealth Management, that's my financial planning firm. And we really take a holistic approach. A lot of the industry really is just built by Wall Street to kind of separate people from their money, put it into investments, and charge fees and commissions and stuff like that. Really having a 30,000 foot view and having a background in insurance, I know that insurance protects the investment plan, the investments fund, the lifestyle. So that's really what we pride ourselves on here. Again, just to recap on what we're going to go over: the current state of care in the United States, kind of what it costs, a couple statistics, long-term care. And, the statistics are about AARP, I believe, is the ones who found that about 70% of everybody will have to have some sort of long-term care for themselves. My position, and just from working with thousands of people on their insurance plans, is that everybody, 100% of people, will be affected by it, because no matter what your end of life scenario looks like, we all are going to have that family member that may need it. And I know, again, when my grandfather was ailing, what it kind of cost our family financially, and then stress. And what was the worst part of that was that he was concerned about the financial stress it was putting on us. And all we cared about was it, taking care of him. So we'll go over the different types of care and a couple legal definitions and how that plays into how people plan for long-term care. And then just at the end, we'll real briefly just go over a couple different strategies that you can use to address the need for long-term care. So there's an organization called LIMRA. It's an insurance basically aggregation organization that takes a look at all the numbers for the different types of insurance it's used, also from AARP and the US Census Bureau. But about 70% of people who make it to age 65, like I said, at some point will need long-term care. So that's them personally. And that can range from everything from, and you'll see in the definitions, just needing wheelchair ramps put into your house. I have a lady in Oregon who had that done, all the way up to skilled nursing, Alzheimer's, dementia, which can last for years and years and years. So 70% of the nursing home residents are women. So females typically go to long-term care with higher frequency than men do. They also typically linger a little bit longer in long-term care once they get there. Men just have a shorter end of life cycle. Not to be too clinical and dry about it, but the law of large numbers are what they are. 38% of people over the age 85 will have some sort of cognitive impairment, Alzheimer's or dementia. I don't know if anybody saw, but all the dementia and Alzheimer's research for like the last 20 years apparently was based on a fake MRI. I can't remember the news story, but it was just amazing. And the whole scientific community is up in arms about it. $102,000 median. So that's the middle annual nursing home cost. Now that takes into account everywhere from very low cost areas to very high cost areas. So that's right in the middle. I'll tell you, here in the state of Washington, I have a client, he's a dentist, and it's a good thing he's a dentist because he kind of drew the genetic short straw. He has not one, but two parents who both were diagnosed with Alzheimer's. And thank God for the profession he chose. He's able to keep them in a very, very nice place. But in his financial plan, I had to address the need for $250,000 a year of long-term care costs to keep his parents in this pretty nice place to convalesce. So if you do end up with cognitive impairment, is really the end of life scenario, typically requires a lot of care. And that is the estimated lifetime cost for someone with dementia. Again, 34 million Americans will take care of a family member and you don't get paid for it. So that's where a lot of this stuff comes in, is alleviating that. So there's different types of care that you can go into. Assisted living, that can range from just apartment in a big living community where maybe you have meals made for you and you may not even eat that much. You know, my wife's grandparents actually were in a place down in Tacoma here. And they had, I mean, they had their own car. They were fine all the way until the end, but they had meals prepared for them and that kind of thing. And that was about $8,000 a month for the both of them. So it was actually, that wasn't too bad. Group activities, that's more independent living. That average cost here in the state of Washington is about $4,500 per month. Adult family home and nursing homes. So that's where you get into more hands-on treatment. I actually am in joint venture with some folks, and we have a couple adult family homes, and I'm out there and I see the high level of care that our caregivers take of people, and it's awesome to be able to help them. But I also know it's expensive. That's where you can get into private or shared rooms, and you're going to pay a little bit more for a private room. There's going to be someone there preparing meals, helping folks with their activities of daily living, which is another technical phrase that we'll cover in a little bit. You can actually be in an adult family home, assuming you don't need any skilled nursing care, which is intravenous drugs, any kind of medical interbody intervention. You can stay there all the way through end of life. So that adult family home setting can run, average cost here in the state of Washington is around 6,500. I would say up to $8,000 per month, kind of depending on the level of seat you want to be in. There's some farther out areas I know that charge less. And again, the Seattle area is a fairly affluent area. So we're probably on the upper end of that, but we're not too far off because it's just expensive to help folks with this part of their life. So then there's skilled nursing. This is where you have intravenous drugs being given, 24-hour care, doctors on call. Those places, I had a friend and her dad was in a place right down here and he had dementia. And every time they had to go into his room an extra time during the night or change an extra diaper or recook a meal or something like that, she said she got a bill every time. And I mean, quite frankly, you'd hope compassion would have taken over at some point, but at the same time, they are business. So that can typically run $100,000 per year. As you can see, especially for a couple, the cost can start to get pretty high. They can eat through a financial plan. As an investment advisor, I can build someone a good portfolio, manage their money diligently, safeguard it from market loss, grow it up into a significant amount, have them enjoy their retirement. But then at the very end of life, one of the things that keeps me up at night about my client financial plans is, oh my gosh, if I get a call in 10 years from their kids that they have dementia, that's really hard for me or any investment advisor to really address. Now, these talks tend to get kind of very money centric, but out of the thousands of clients that I have helped with these solutions, 0 out of 1,000 have ever focused on the money. The dollars and the cents, the IRAs and the 401ks, they don't care. I hear basically three things. I don't want to be a burden to my kids or my grandkids. And it usually starts off with, hey, I just paid for my mom and dad, or I just helped pay for my in-laws, or I just helped pay for my grandfather and grandmother to go through this. And there's no way, Chris Reed, I will not do that to my children, fix this problem for me. So the second most common comment that I get is, I've seen what end of life scenarios can look like if you don't have what you need to take care of yourself or to be taken care of. I do not want to go to somewhere where I'm not well taken care of, or someplace that isn't going to give me the standard of care that I want in the end of my life. And then finally, for married couples, that's always the big one is, if I go, I'm not going to be here to take care of my spouse, or I don't want my spouse to have to take care of me. So again, on finances, the dollars and the cents are kind of the tool we use, but it's really these other bigger concerns that we use them to address, is how we feel about what that money can do for us. So luckily, there's long-term care insurance. And if long-term care insurance was as easy as some of the other insurances, it kind of wouldn't be a big deal just to go out into the marketplace, pick the best one, pay for it, and be done. Unfortunately, we have to go through a little bit of backstory. So if you didn't realize when you logged on tonight that you were going to get a history of long-term care, buckle. I will try and make it as exciting as possible, but it's very, very important to know what the landscape looks like right now, because you can still go online. You can still go on Google and Google long-term care insurance, and someone will sell you a policy, but you really have to know what you're getting into, because things got very bad for consumers. But then ironically, like I said, in the insurance world, for some reason, innovation of the different products that are out there, this is the one space where things have actually gotten so much better for consumers. This is basically a brief history of the long-term care insurance market. And what you have to understand is why it's happening. And why it's happening is because back in the 80s and 90s, really when long-term care insurance came about, you have to think about the world at that time, what medical science did at that time. So the average life expectancy back in 1985 was about 73 years old. So in 1985, there was a bunch of 40-year-olds who went out and they called up their insurance guy and they said, hey, I need some long-term care insurance. And the insurance broker said, okay, no problem. And they went out to your Genworths, your Mutual Omahas, they went out to your New York Lifes, and they brokered that deal. And that's fine, because the actuaries at the insurance companies in 1985, they said, well, yeah, of course we'll write that policy that, we only expect that individual to live to be age 75. Here's their benefits and here's the premium. And they were issuing policies with very, very big benefits, very rich benefits, and they weren't charging very much. So whenever I run across someone, and it's less and less and less as time goes on, but whenever I run across someone with a policy from the 80s, I tell them, hold on to it with an iron grip and never let it go, because all those 40-year-olds who bought those policies in 1984 got 10, 20, 30 years older, and now they're in their 70s and 80s or 90s. So now in 2022 and 2023 that we're going into, medical science has advanced so far that the average life expectancy, it's actually higher than this now. I mean, we're in a little downtick, add another 10 years. But, the average life expectancy in the United States now is almost 15 years. And the end of life care has gone up, and people are diagnosed and treated for things that can extend their life. So if you had Alzheimer's in 1974, your life expectancy maybe was 6 to 12 months. Now it can be 2 to 4 years. So going back to the earlier slides, you can understand that these insurance policies they wrote and charged very little for now are bleeding. And they were bankrupting traditional long-term care insurers. How the industry dealt with that, and they were issuing policies 10, 15, 20 years later in the 90s and 2000s. And because of the technical legal type of insurance that long-term care insurance is, which is guaranteed renewable. So if you see here, guaranteed renewable means that insurance is like your health insurance. They have to renew it every year. The insurance commissioner in every state says you must renew it, but you can raise their rate by class. And all the insurance companies have to do is walk in with their books and say, look, we have to raise these rates, otherwise we're going to go broke. And the insurance commissioners approve every rate increase. It's just almost automatic. And what this translates to is I called a gentleman who lives out in Carnation here in the state of Washington. We'll call him Jim. And I said, hey, Jim, it's Chris. He was a referral. And I said, your friend said you had some long-term care questions, or I can't even remember how it started, but he started the conversation, and he's an older gentleman, and he's a funny guy. So anyways, He said, "Don't you stinking talk to me about stinking long-term care insurance." And he hung up on me. And I went, "Whoa, hold the phone. Okay, I know what's going on." And I knew exactly. I said, "Hey, Jim, let me guess. You got a letter from the insurance company." And he said, "If they raise my rates one more time, don't you talk to me." And I said, "Okay." So I went out there and met with him. It turns out we're friends now, and I helped him. I fixed the situation for him, and he's just so happy now. But because the insurance companies were going broke, they started raising rates on all these insurance contracts that people have been buying. So that's what's exactly what's going on. Recent policy purchases are paying the load because of the mispricing of the old market. People are living longer. And the other thing about those old policies is they were like your auto insurance. You would pay on those policies. And then if you just died, they would never pay a benefit. Now, auto insurance is very important. If you never use it, that's good for you. Life insurance is very important. If you never use it, that's good for you. Long-term care insurance, same thing. But that's just one of the differences that we'll take a look at, that things have really changed. The situation is so bad, and so many people were complaining to the state of Washington that the insurance commissioner actually has a page on their website where you can go and you can read about it. And it's going to tell you all about guaranteed renewable. Like I said, the math and the numbers, money in the bank is one thing. This is what really hits home. And I think this is what it's all about. This was in Money Magazine, I believe. This lady, Julia, had gone through exactly what I'm talking about. So in 2016, she took her policy in 1996. 20 years ago, she thought to herself, you know what, I need to take care of this need. I need to do it now, and I'm young. So she bought that policy when she was 49. Insurance companies don't do this right away. You buy the policy in the year 2000, they're not going to start raising your rates in 2001. You'll kick them to the curb. They're going to wait until you feel pot committed. They're going to wait till you've spent a bunch of money. When people put money into a policy and then they are told they might have to walk away, that's very hard for them to swallow. But actuarially speaking, and it's justifiable on the insurance company's part, they're not evil. They're looking at the mathematics and they're doing what they have to do to stay solvent. This is where the rubber meets the road. They quadrupled over 2 years her insurance premiums. So what was once very affordable and a very good part of her financial plan really quickly became a financial burden. And then anybody in this situation is stuck making that really, really tough call. Hey, what do I do? So this is what one of those look like. So this is from another client. She lives east of the mountains. Over here, they sent her current benefits, her daily benefit, 5% compounding interest, 50-day waiting period, unlimited benefits, unlimited lifetime benefits. And she was paying $876 a month. So that was her old policy. Well, exactly what I talked about happened. So they sent her options, and it's literally a one-page form, and they say, check a box. What do you want? Do you want to reduce your benefits and be completely paid up and never pay again and have this be your benefit? Do you want basic paid up benefits and we'll give you a little bit of cash? I think is what that offer was. This one, they want to take away the benefit increase, meaning that inflation adjustment. They want to remove the inflation and reduce it. So different companies have different levers they pull. At the end of the day, it just means that you're either going to end up paying more or receiving less benefit. And the worst is, and I told her this because she was loath to let this go, was this was the first letter she got. Just because you check that box and mail it back to the insurance company doesn't mean you won't get another letter a year later where your benefits, like Julia in the last example, they quadrupled up and it took them 2 years. So what they probably did was they doubled it 1 year and then they doubled it the next year. She paid it, but I bet she didn't pay it for much longer. Okay, so enough with the doom and gloom, enough with how expensive it is, enough with the insurance companies getting away with all your money. Now let's get on to some of the solutions and then we can get you folks out of here. So the old style, again, guaranteed renewable, means that the premiums can increase and the benefits can decrease. You have to agree to it. But if you don't agree to it, they can just drop you. Again, premature death, or if you just live your full life, but you never need long-term care and you just pass away at night in your own house, there's no benefit and they're typically reimbursement. So those policies are very thick, they're very wordy, they're very legal. And so what that means is if you go to Shady Acres because you have dementia and you get tapioca pudding instead of chocolate pudding, somewhere in that contract, it might say, hey, we're only reimbursing for chocolate pudding, but you love tapioca, right? So reimbursement policies, they're like your auto policies where you go get in a bang up car wreck and then you take it to the shop and then the insurance company wants to fight with you. What happened was the 2 of 6 activities of daily living. Now, that's a legal definition and it comes from the Internal Revenue Service. What happened was and why this is a strange part of the world where things have gotten better for consumers was long-term care insurance companies were issuing policies and they said as soon as you were unable to do two of the six activities of daily living, you qualify for benefits. Well, life insurance companies said, hold the phone, there's a big market out there and that whole part of the market is burning to the ground. What can we do to take on some of this market share? What they did was they took and they created a rider. And that rider has the same legal definition for benefits as traditional long term care insurance. And they created that rider and they simply inserted that language into their life insurance contracts. Life insurance contracts then became a hybrid, part life insurance, part long term care insurance. And life insurance contract, they're what's called non-cancelable, which means once the benefits and the costs are agreed upon by both parties, it's a contract of adhesion, they cannot be changed by either party. The only party that can change it is the policyholder, and the only way you can do that is by stopping payment, and then they're allowed to cancel it. Legally, what it means is the insurance company can't go to the insurance company and ask for a rate increase. They can't send you a letter saying that you have to choose a reduced benefit. So it's so much more advantageous now for consumers. Ironically, again, one of my favorite things is if I'm ever, allocating people's resources, allocating my own resources to my own insurance planning. I don't like paying for insurance any more than anyone else. I do not like it when money goes out the door and I don't get anything for it because of the new hybrid, because it has a death benefit, because of the life insurance component. There's always going to be something coming back to the family. Now, depending on the plan you take or the different product you use, that could be a high death benefit or a low death benefit, or it could be in the form of the long-term care insurance, or it could be a mix of both. That's one of the things that my clients resonate to the most is, okay, well, I'm willing to pay this premium. And man, at some point, either me or my kids or my wife or my husband is going to get some money back. That's a good thing for our overall financial. The new plans can be reimbursement or indemnity. That's really up to your insurance broker to know the difference on which one it is, on what the fine print is. I have 25 different insurance companies that I can go to for any given client, depending on what they need, what they want. It's very, very important to know the insides of those contracts because that could mean the difference between having to fight for tapioca pudding or getting whatever kind of pudding you want. Indemnity policies are the best because the only thing that is required for an indemnity policy to kick in is again that legal definition of two of the six activities of daily living, and then they're mailing you a check. So a good example of this is I have a client in Oregon who, when we think of long-term care, we kind of think that you're stuck in a home or you're unable to care for yourself. Well, this lady is awesome. She's wakes up every day, gets out of bed, makes herself breakfast, and goes and meets her girlfriends for breakfast. The only problem is she can't get into her shower. Well, she couldn't get into her shower. Every time she got in, she would slip and fall. So that's bathing, right? So she checked one box. She was also incontinent. So she had to wear adult diapers, no big deal. So she checked the boxes. She was unable to bathe. She was unable to care for her bathroom needs. So she qualified. So we went to the insurance company, filed a claim, and they mailed her a check for $200,000. And she had wheelchair ramps and a new bathroom put in her with a walk-in tub into her home. So now she gets to spend the rest of her days in her home that she loved because she had an indemnity policy that paid her directly and she used that money for exactly what she wanted. So again, we're going to go over this pretty quick because I just hit most of it. The old style, which is reimbursement, that's just like your auto insurance. They might fight you on it, they might not. Chances are they will. The new style, the hybrid style, again, that's where you get that indemnity payment and there's a death benefit and a long-term care benefit, and the full policy is going to pay under one of those two scenarios. Okay, so real quick, I'll just touch on funding and then we'll wrap it up. You can fund these like a traditional insurance policy where you pay a monthly, quarterly, or annual premium. You get qualified medically. Underwriting for the new hybrid style is so much easier than it was for the old policies. The old policies were underwritten on morbidity, meaning they didn't want to write a long-term care policy for someone who was sick or injured or was going to cost them a bunch. That's morbidity. The new policies, because they're grafted onto a life insurance contract, insurance companies don't care really about anything except what's going to kill you. So if you're even moderately healthy, you can qualify for the new style, and the rates are actually much lower and they don't go up over time. And there's a death benefit, et cetera, et cetera. That's one really cool feature is that people who were unable to qualify before now are able to qualify for the new hybrid style. You can have things like inflation protection built in for cost of living adjustment, that type of thing. And another great thing is that the benefits a lot of times are tax free. So if you have a $500,000 policy and you need to advance $200,000 for your long-term care, depending on the IRS limits at the time, that potentially could all be tax free. So, and that includes any growth. So if you paid $100,000 for a $200,000 policy and you drain all that money out, you could potentially be getting away with reducing your taxes on that growth that you're then using for your long-term care. Last couple slides, and then we'll wrap it up. This is just an example of a premium payment method. This is a really great product. This 60-year-old female would have paid $9,200 for 10 years. So paid a total of $92,000 into the policy. So again, we typically set these up to stop paying once people retire, because you don't want to be paying a bunch of money for insurance when you retire. This lady had a $400,000 benefit. So she paid in $92,000. She had a $400,000 benefit. The second part of this was the long-term care portion, which said if she went into long-term care, it was going to pay $96,000 a year for 4.2 years. So there's your $400,000 benefit. So as a financial advisor, as much as financial advisors love to hear themselves talk about investments in the stock market, if I would have asked this client to give me $9,200 for 10 years, could I have turned it into a $400,000 benefit? Potentially. With the risk to reward and the guarantees built into these, was I much more comfortable having just her pay an insurance company? Absolutely. And then this one actually has an income rider on it, where if she outlived and didn't need the long-term care, it was going to pay her $400,000 back in income tax-free later on in life. So very creative once again. And again, my favorite part is that these days it's kind of a no loss scenario. The other way that I pay for these is called asset based. So if we come back here, usually when I'm just doing like a portfolio review, a financial diagnostic is what I do in my company. I take a look at taxes and volatility and inflation and fees and the whole nine yards. It is surprising how many people have a lot of money sitting in buckets that is going to sit there till they die and not provide very much benefit. So we're talking about checking accounts, savings accounts, certificate deposits, even bonds. I was just working with a lady who's at Merrill Lynch and they have $2 million. And I looked at the statement and I said, we got about $700,000 that's just sitting here, and bonds have gone down 20% in the last. So what are we doing? Right. So we elected, it just made sense to move that conservative money out, reallocate it to this solution. So that's called asset based. We just take a look at the accumulated assets. And on average, people who are approaching retirement typically have a lot of their net worth tied up in just very, not Bitcoin, in very conservative assets. So a lot of times paying for these things seems kind of scary, but really when I describe it and I talk to it with my clients about, just consider your money is just sitting in buckets. This money is in a non-risk bucket. So all we do is take money from one bucket and then we hand it to an insurance company and we have another bucket of money going. It's just serving a different purpose, growing in a different way. So this is an example of that. Had a client was about 55. We just took $155,000 out of their conservative bucket. I have a client down in Tacoma. He's older and he has $300,000 just sitting in Bank of America. And his comment to me was, I make nothing. He said, I make nothing. I haven't touched a penny. I'm not going to touch a penny. Can I just use that money? And I said, sure, just write a check. This client right here was going to parlay that $155,000 into about $840,000 over 20 years in long-term care, right? Probably they would not need it until they were 84 years old. So really what we were doing is taking $155,000 and just offboarding it, putting it in another bucket. And eventually we completely solved this client's long-term care need. So these two are medically underwritten. There's even some fixed indexed products out there that are non-medically underwritten. I showed this option to that same client. $155,000 would grow up with the stock market when the stock market's good, lock in the gains. They never had to worry about market volatility. They could have walked away with all that money and if they have ever wanted it. After 30 years, again, 5 payments of $200,000 is another $1 million benefit. So those are the different numbers behind long-term care, the technical legal definitions of long-term care, and how to address the need for the long-term care to make sure that all those needs get taken care of. Taking care of ourselves, taking care of our spouses, making sure we don't burden our kids. So that's going to be it for the webinar. I hope it was very, very helpful for you.